Since we last had office hours with Professor Mark Guthner, we have had some new GDP numbers. He has some opinions about that. We've gotten Amazon's earnings. I have some opinions about that. We're going to talk about both and take your questions today during office hours on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Interest, and welcome to Office Hours with Professor Mark Guthner of Rutgers. Mark, how are you, my friend?
I'm doing terrific, and school is almost over, so I'm looking forward to a little R&R.
How long is your break, your summer break?
Oh, it's about 3.5 months.
Oh, I should have gone into academics.
Yes, I could teach in the summer if I wanted to, but I don't, and I'm gonna. Normally the tenure track professors use this time to work on their papers, academic papers they're trying to write. That's a typical thing. I'll be teaching some introductory kind of stuff. We've got masters of quantitative finance students coming in. So I got little things to do with them in the middle of this summer to get them teed up for their program. But for the most part, this will actually be the first summer I haven't done very much, although I'm going to build a class on fintech this summer. So I will be busy, just not in the classroom.
So we did get those GDP numbers. I wanted to, this is sort of a generic question or comment that was made in one of the recent live streams. It had to do with Pfizer. We have a regular viewer named Michael Anthony, and we're not going to get really deep into Pfizer, although you and I were talking about weight loss drugs, and they've had some trouble in this area, so they don't have something to compete with Lilly and Novo all that much. I have it on my screen. This viewer had made a comment, and this is more of a general question, which I thought would be appropriate for a business school professor to answer. So Michael Anthony had said, Pfizer sold shares in a drug company in the UK, and the sale of those shares raised $3.24 billion. And his comment was that Pfizer gets no credit for that cash. And I now have on my screen, I don't know if you can see it, but actually I came up with a time series because I think there's two important points that I would like to make, and then I'd love to get your thoughts. When people think about cash on the balance sheet of a business and when companies bring cash in. So how does one put cash on the balance sheet? You can generate cash from operations. You can raise cash by either selling assets or selling securities, basically. That's really the principal ways that cash can get added. One of these obviously has a lot of value to a business. If a business that previously did not generate cash, but now suddenly does, and that cash is growing, the rate of cash flow generation is growing, then that adds value to a business. But if you simply take an item on your balance sheet and swap it for cash, that is not necessarily going to be good. It could be, depending on whether the firm was in a bad cash position and people thought there was default risk. But what I put on the screen here is the net debt for Pfizer over the last 10 years. And what we can see is that it rose from about $5 billion 10 years ago to over $50 billion going into the pandemic. Then it plummeted to 10-year lows. Not surprising, because Pfizer was one of the vaccine manufacturers, so it was generating massive amounts of cash. And of course, that is no longer the case. And in fact, the net debt at Pfizer rose to levels even larger than it had been pre-pandemic. It has since fallen back a bit, possibly in part because of asset sales raising some cash. What are your thoughts? How do you like to think about cash on the balance sheet and cash flow generation?
Well, you've covered it pretty well there. The big swing, of course, is they made a lot of money by selling vaccines, this mRNA thing. And then, they did make a huge acquisition. I don't remember what the name of the company is. And so they spent cash. I'm sure they took on some debt to do that. It was a huge acquisition. And I don't recall the terms of it. You caught me flat-footed. Otherwise, I would have done a quick lookup before the talk. And then the question I have, if they raised $3.5 billion, I don't know the story very well. Did they sell some shares in a subsidiary, or did they sell stock in Pfizer?
This was of some UK holding. That's what Michael Anthony was referring to. And actually, this isn't a question so much about Pfizer as it is more of a generic issue. Things to think about as we look at companies, because, I think it's always helpful to look at a stock, specifically so that people can kind of have an example to work with. But I think it's the broader question that's more important, and that is that, we value cash arriving on a firm's balance sheet differently depending on how it got there.
Well, yeah.
And
The only thing that's real value is, cash generated from operating activities. Everything else that you put cash on the balance sheet that's a financing decision. Did you sell some stock? Did you sell some debt? I suppose you could also get it if you sold a division or some equipment or something like that. Those are one-off transactions. So that doesn't, you can't make any long-term generalizations about that. But so I like to look at, when I think of a company, I look at the cash flow statement. I love the cash flow statement more than the income statement, but I'll look at the operating income minus CapEx. And that's the number that I like to keep track of, because that's the number that management has something to do with it. If that's negative, that means they are investing more cash in their business than they're generating. That's often the case in a fast-growing company, especially one that has manufacturing element to it. And then with that cash, they can decide, do they want to pay down debt? Do they want to pay a dividend? Do they want to buy back stock? Do they want the cash, as Warren Buffett does, let the cash build up on the balance sheet and wait for an acquisition or something, strategic to do with it. So
yeah, I brought up the cash flow statement here of Apple. I mean, we talk about companies that generate massive amounts of free cash flow from operating activities. I don't know that there's a better example than Apple, and I understand that net of the most recently announced buyback, that they are going to have repurchased something like $830 billion worth of their own stock, in Apple's case, by the time the most recently announced buyback plan runs its course. And one of the other things I would quickly say is that in Apple's case, because it generates so much free cash flow, and because they didn't necessarily think that having cash on the balance sheet was of such great value to them, particularly when rates were low, what they did actually was they not only bought back stock, but they issued debt, not for any business reason other than to repurchase stock. They were able to borrow long at very low rates. The company had nothing in the forecast which would suggest that repaying that debt would be a challenge for them, and certainly it has proven that it was not. And that was effectively accretive for shareholders. I mean, at one point, this was a company that was 40% cash for every share back when it was and that was actually not a positive for the company. So this is just sort of a general statement that you do want to see cash, but it's the source of that cash and it's the appropriate use of it that's important. And in the case of Warren Buffett, as you rightly point out, his business is buying businesses. And one of the other things he is very opportunistic. He is a source of liquidity when liquidity dries up.
Yeah.
So for him, having a great deal of cash is obviously a benefit. And it's also a byproduct of the business he operates, because they're largely an insurance company. They're collecting premiums all the time. It's a huge cash flow generator.
Yeah.
So anyway, that was just something I thought we would touch on, and I think we can move on to the broader issues of the day, because I know you have some thoughts on this.
Before we jump forward, Mike, I'd like to remind everybody that Berkshire has its annual meeting tomorrow, and he now televises it or telecasts it, so you can watch it on online. So for a long, long time, he refused to put his meetings online. You had to be there in person for it, and it's quite a spectacle because they fill up a stadium full of people that want to hear his musings. So I would suggest to folks, if you've got some time, to log in and have a listen to what he's got to say.
Yeah, it's always a good listen. I enjoyed the interplay between him and Charlie. So I'm sorry that Charlie's gone. He obviously lived a full and successful life. I think your dad knew Charlie, didn't he?
Yeah, my dad used to play, I think it was bridge with him, but he might have played some dominoes too. But they're members of the same club in downtown LA. And yeah, my dad did that for a lot of years and never talked business, strangely enough. They were both lawyers,
Mm-hmm.
and they both ran law firms, for that matter. So, but I guess they had a club rule. My dad said when I asked him, I had met Charlie when I was a freshman, I think, around college, at a different club. But I had met him and said hello and stuff. And then it wasn't until 2 or 3 years later that I knew who he was. And that's when I asked him,
Mm.
that Charlie Munger guy you introduced me to. And I go like, he's like the greatest investor ever, right? And he goes, yeah. Did you guys ever talk investments? And he goes, no, it's against club rules to talk business. And I'm going like,
I
I'm gonna die right here.
I think that was actually, I think that was much more true, that it was considered impolite and rather gauche, actually, to discuss business affairs in these clubs, which were generally thought of as being social settings, not business
Yeah.
opportunities. So, yeah, I encourage people do tune in to listen to Warren's musings. I'll be very interested to find out eventually who ends up replacing him, and I'm also very interested to know whether the company has, net of the market's declines, elected to start deploying some
Yeah.
of that enormous cash hoard that they have. What is it, $340 billion right now, or
At
something like
least.
that? It's a massive number.
At least. By the way, if you want
Yeah.
to read some of Charlie's stuff, he wrote a couple of books. One was called Poor Charlie's Almanac, and the other one is a book called Damn Straight. They're both fun books to read, and he talks about investment philosophy in both of those, and they're nice reads.
As of year end, 334.2 billion in cash and
Yeah.
equivalents. And let's see, what were they? I'm just curious. We'll take a quick peek at how rapid, because that number has almost certainly gone higher
Yeah.
in the intervening months. So that'll be very interesting to listen to. Okay, so let's move on to this GDP thing, because I know you had some thoughts on it. We got a negative GDP print. The street had been looking for a positive number, and everybody got all weak in the knees
Yeah.
because they said, we're definitively in a recession. You have brought up a formula for GDP in prior contexts, and I think it's important we bring it up now. And what is that? What do we need to
The
look at?
GDP, well, how do you measure it? It's consumption spending, it's investment spending, government spending, plus net exports. So if you have exports that exceed imports, then that's a positive contribution to GDP. One of the things that was very predictable, and I thought we were going to have a negative number. I actually thought we were going to have a bigger negative number than they had. I tend to look at GDP now, which is what they call a now forecast done by the Atlanta office of the Federal Reserve. They're scraping the internet every day trying to figure out the amount of economic activity going on, and they had a bigger number. So those two things. But my thought is that there's going to be a big rush to import as much as you can to get it in under the tariffs. And maybe that's why, Trump was flip-flopping back and forth, was he might have been, covertly um, allowing people a little bit of cover to go um, do import as much as they could, and be prepared for what's coming up. So since the net imports went up a lot, that was a big negative contribution to GDP. So without that, we actually would have had a positive GDP number. So it's unfortunate that that's sort of a bit of a wild card. I'm not sure how you would predict that if you're a typical econometrician. And kind of put a little thumb in the air, and that's all I did. But
So I've just pulled up a chart right here, which I think kind of illustrates what you were just talking about. I don't know if this is going to be clear enough or not. What you are looking at right now is a chart of the U.S. balance of trade. As the chart goes up, that means that our net exports are increasing or our net imports are decreasing or some combination thereof. And as it goes down, it suggests that our net imports are increasing, our net exports are decreasing, or some balance of these. And it speaks exactly to what you were just saying. This right here is we just had the largest trade deficit in the nation's history for a comparable period. And 122.7 billion was just for February. I think we can estimate that March and other subsequent months were probably in advance of the tariff. So this makes very good sense.
Yeah.
Right? If you know that you are going to need to buy some product, and you know that that product is going to go up by 10% because of a unilateral tariff with the EU, or 25%, you would probably accelerate some or all of your anticipated needs. But if you are importing from China, and you know that you're going to be hit with 100% tariff or more, you would say, I think we ought to stock up now.
Yeah.
Because what's the best circumstance? The best circumstance is that you get back to where it was before.
Yeah.
It's very unlikely that it's going to be lower than it was. So accelerated purchases would, therefore expand the trade deficit. And expanding the trade deficit lowers GDP.
Yeah.
And this is 122.7 billion for one single month, right?
Yeah.
So if we we'll call the economy 30 trillion, right?
Good number.
As just a round number for the year. So that's going to be $2.5 trillion per month, right? So 122.7 billion, and it was almost, like I said, almost certainly larger in March, on $2.5 billion is almost 5%.
Yeah.
5% of GDP, folks, is what the trade deficit alone represents. So if you had all else, think about that. If you want to think about something that's really astonishing, is that if the economy was humming along, all else equal, but we did not run a trade deficit of that magnitude, we would have the largest economic growth probably in the nation's history. Of course, it doesn't work that way.
Yeah.
But it just helps give some scale to the numbers. So I think that was a very good and important point.
So I popped a little note up on X to show that and show that it's about 5%, which I think is good. The other thing that we should now recognize is we'll probably import a lot less in this quarter. So if there's going to be a surprise in the GDP print, it's probably going to be to the upside this time.
Right. Yeah, it's very easy, I think, for people to neglect, how big a swing these types of things are. And actually, Zero Hedge, let me see if I can find it. Was it Zero Hedge? I think I was alluding to this earlier, but they were talking about the fact that they had some pictures of the ports.
Yeah.
And they were showing that the ports were basically devoid of activity. Now, I don't know if that's true. I was tempted, and had I had more time, I might have just jumped in the car and gone over and had a look. We have a lot of, in the East Bay, there's a lot of port activity. And if I still lived in Los Angeles, then I absolutely would have wanted to go down to Long Beach and check it out, because that's one of the largest ports in the world.
It is very big.
And of course, not only are our ports particularly, not only are they large, but they're particularly important for measuring the activity with Asia, because of course that is traffic that's crossing the Pacific, and that I think would have been very interesting to see. People will remember that we had all of these supply chain disruptions. One of the things that happened was several of these ports actually got backed up. They had too much stuff going on, and they were really struggling to move goods throughout the port. Containers were stacking up, trucks were lining up, and there's an optimal balance that can be found so that you are as busy as you can be, but not so busy that it actually impedes your ability and throughput. So I think that was fairly interesting. So something else I thought was worthy of note, two earnings that sort of caught my eye and things that we were talking about and thinking about. One was that McDonald's earnings was a little bit disappointing, and the stock fell as a result. That caught me, I will admit, a little bit by surprise, because my original thinking had been that the company might benefit from consumer substitution, which is a well-known sort of concept in economics. It actually is one of the reasons why they manipulate the CPI data, because they account for substitution. People decide to buy chicken instead of beef. My thinking was that there was going to be a trade-down effect. So stretched consumers who might have gone to a fast casual restaurant decided that rather than spend $20 plus tax and tip, would just spend 15 and go to McDonald's or something like that. And their sales were a little bit disappointing. Do you have some thoughts about that?
McDonald's has been having some trouble for a while. They've kind of stalled out. I don't know if that's company specific. I don't know if it's the Wegovy effect, where folks are taking their little shot in the hip to lose some weight. And what I've been reading is that not only does the drug make you want to eat less, but it tends to get people to eat less calorie dense food, not to buy foods that have a high sugar content, high fat content, high salt content. So maybe there's a little bit of that going on. It's hard to say, and so I'm not really sure, but I don't think any of these numbers are disasters. I always kind of get a little bit surprised how much Wall Street reacts. Oh, it's 0.5%. They missed revenues by 0.5%. We're going to take the stock down 10%. Anybody that runs a business knows that there's just some random variability that takes place, and there's some noise and there's some cyclicality, and all these things take place. The one place you can find a straight edge is at a Wall Street brokerage or research report, because they like to take whatever and then they just take a straight line trend, and the world just doesn't work that way. So I tend not to get too worked up over that.
So you and I, before we went live, we were talking about Cheesecake Factory. So just some things to think about with respect to the weight loss drug impact that Mark was just referring to. Now, we don't know exactly what sort of the constant run rate of prescriptions for these drugs is. We were taking a look at a couple different estimates. Maybe 2 million, something in that neighborhood could be a decent estimate, but everybody's welcome to take a look and judge for themselves. But here are some things to think about and what we thought about as we wondered whether this would have implications for some of these businesses. So you're going to reduce the appetite for certain foods. There's about 2.5 people per household. I'm going to assume that the people who would take these drugs are probably not the kids, right? And
Yep.
probably not the 80-year-olds. So the concentration of people taking weight loss drugs is probably greatest among discretionary dining decision makers. In other words, the people within a household that are most likely to make the decision that, hey, we're going to go out to eat tonight and let's go to Cheesecake Factory. Or let's go to, you know, salad restaurant or whatever whatever it is.
Yeah.
And the reason I bring this up is because the impact is probably going to be more, and I also imagine that there's a greater crossover amongst those who are on these drugs or need or should be, and those that eat at restaurants that are known to have very high calorie foods, Cheesecake Factory being notable among them. So I bring this up because it showed up in their annual report that it is a risk. It was in Cheesecake's annual report that diet drugs may have an impact on sales. They didn't quantify that. There's a lot of boilerplate, as all will know, in annual reports, and especially in the first section. You go through a 100-page annual report, and the first 3 pages are this could happen, that could happen, there could be, a tidal wave, terrible floods, and on, stuff like that. But I thought that was kind of interesting because in the case of Cheesecake, you made the observation that you thought the valuation sort of was discounting this somewhat because it was trading at a relatively low multiple. So it's looking at year-on-year EPS growth of negative 20 cents for this year. But the street's still looking for $4 and change next year.
20 cents is not a big number out of $4.
No, it isn't. What is interesting to me is that they're expecting record profits in 2026. And I'm not 100% sure I understand what the magic bullet is going to be. But I will say that at 12 times earnings, it would start to be a little bit interesting. But I thought I would bring up that risk factor because it's one of those things that we haven't really talked about much on this channel. When you have these sort of new regimes coming about that can completely change things. Okay, so
if I can comment on that, Wall Street is, and the analysts and the companies maybe using sort of the confusion right now to just sandbag a little bit. That we don't know how that's going to work out, so let's be conservative and shave our estimates a little bit. And as I mentioned before, they could get a boost out of all of this, in that if people are buying less things, they might be doing more things. Instead of buying things, they'll be doing things, and so maybe they go out to dinner a little bit more instead of buying whatever kind of item they might be buying because they don't want to pay the higher price. That could be something that's going on. It could also be that analysts are just saying, okay, we're kind of in this cloudy area right now. It's all going to get cleared up within a year. So we're back to go in 2026. So I think there's a lot of different reasons why they could be having that view that they have. I mean, some people just think, hey, the tariffs, people don't know what to make of the tariffs. And so maybe the knee-jerk reaction is to do less. I know in my case, I haven't changed anything a bit except that I bought I bought a computer. And otherwise, I wasn't gonna. I've been waiting for an iMac with the M4 chip for like 3 years now or something. So it had nothing to do with the tariffs. It's my computer at home was so old that I needed something that was a little faster than 4 rat power.
Tariffs impacting the cost of imported electronics and therefore potentially bumping up the price didn't accelerate your purchase at all?
It's like I've been waiting it for 3 years, and so I've been ready to do it. I was actually going to do it in the summer and not rush out during school to do it, but maybe I moved my purchase up 2 weeks. If let's say the price went up like by 20, with Macs you're paying a premium price already. If that was another 20 on top of that, then maybe I would have delayed and waited, till the tariffs came back down. I don't know, but I've been wanting this computer for so long because my computer was a 2017. I've got an 8-year-old computer that as the operating system keeps getting more and more sophisticated, the machine gets slower and slower and slower. So I've been dying to get a new computer for quite a while.
So now that we're kind of on the technology conversation, we got some big earnings results. We got numbers from Amazon. I actually posted to the Options Edge about this before those numbers came out because I feel like that stock, in my view, is cheap. I still feel that way. The stock hasn't really reacted. It's up $2, about 1%, after reporting those numbers. They beat on the earnings line. The disappointing side, I think, for some was that AWS perhaps didn't grow quite as fast as some had thought. And they also discussed in their guidance, to the extent that they were offering it, because folks who are watching may remember that Amazon contemplated putting the tariff impact on their website.
Yeah.
And then apparently Trump had a conversation with Bezos or somebody, and they decided not to do that. But they did on their in their earnings discuss the fact that the tariffs were going to have some impact on sales, and so they built that into their cake. What do you think about the fact that Amazon's trading 25 times, Walmart's trading 30, Costco's trading north of 50? Don't all these companies have some exposure to China? And doesn't Amazon actually have big portions of their business that aren't exposed?
I'm in the middle of so can you come back later? Okay, bye.
So everybody who's watching this gets to have office hours with the professor, but the other person has to wait their turn.
He's got to wait his turn. Sorry. So where were we? I'm sorry.
Oh yeah, no. So what I was asking about was Amazon appears to be trading at the multiple that it is because of concerns in part related to China. It doesn't seem to me that other companies that are similarly exposed are similarly affected in terms of the valuation. That is to say, Amazon's trading 25, Walmart 30, Costco 50 plus, whatever. I'm not saying that they all have equal weight exposure, but also Amazon gets a lot of their operating income from AWS, which is not.
Yeah, this whole space has been expensive for a while. At least I've felt it's been expensive for a while. Nobody seems to care. It's part of my overall thing that I think most stocks are overvalued right now, given the probably a long-term growth rate of GDP for the U.S. But it's kind of like the best place in town, the best place on the planet. I would much rather be investing in the U.S. than Europe, for example. And I'm sure the U.S. attracts a lot of money from Europe. And these big companies are the magnet for that money and keeps their share prices elevated. So there's always this old thing that don't bet against the American consumer, because people here are pretty good at borrowing money and making money and spending money, so I think the valuation, like relative to itself for the past couple of years, probably fair value. Over the super long term, probably a little expensive. But where you live in the short term, not the long term.
Yeah, it's it's interesting. I was talking to my former colleague, my former boss, actually, from Ivory, and his point on the valuation front for U.S. equities was that one of the reasons that U.S. equities look relatively expensive now is because, in his view, they were grossly undervalued for a long time.
It could be right.
That people did not appreciate their pricing power, their ability to improve productivity, and Mark, you'll remember this because was it 2012? I think you and I were on a road show where we were going around to different asset managers. We flew actually to the West Coast, and I think we were basically touring a lot of the The Cubs essentially that had come out of Drexel Burnham's West Coast high yield bond business.
Yeah.
And so there's a lot of fixed income managers in Southern California, people that were, who had worked with or worked for or were somehow associated with Michael Milken.
Yeah.
And my former boss started off as a high yield guy. So he's a big equity investor now. We went around talking to people about hedging. And what did they have to say to us? We said, do you want to hedge your fixed income portfolios with equities? And they said, no, we want to what?
Yeah, hedge our equities with fixed income.
Yeah. All of these guys were asking,
how do we
when
get
we
more
went around,
stock?
They said, we want to be long stocks.
Yeah.
They're like, don't talk to me about the downside risk to stocks. Tell us how we as fixed income managers can get exposed to the upside because they're so much cheaper than bonds.
Yeah.
And they were right.
They were right.
They were absolutely right. And I think for folks that came from that background, it's a funny thing. I mean, you've been in the business a long time. Oftentimes there was very little crossover between fixed income and equity guys. You lived on different floors. You never talked to each other.
Yeah.
You rarely, it seems almost impossible to imagine, but we didn't talk about valuation very much with each other.
We didn't. One of the things that I've been thinking about, because I teach this in my asset pricing class, is companies that are not capital intense trade at higher PEs than capital intense businesses because they're not capital constrained. They can grow much faster. And so I've been thinking about as our economy moved more from a manufacturing, food-based kind of economy to much more service-based and tech, software kind of businesses, that maybe the whole world here in the U.S. just should be in, 5-6 turns higher than it used to be in the past. And that instead of 15 being the average, I think the past 100 years, maybe going forward, it should be more like 20 for the S&P or maybe 22 as a long-term sort of Lorenzo tractor, if you will, to where PE, equities are going to be priced. So go ahead.
Well, I was going to say in defense of that, I mean, take a look at General Motors. General Motors is trading 5 times.
Yeah.
Full year 2026 numbers, and this is a cyclical business. It is a capital intensive business. It is a competitive business, and you have other businesses.
Airlines. Airlines are going to trade at a low PE, very capital intensive, and then you look at software at the other end or SaaS business models. And this is one of the reasons why people keep saying that Apple deserves a higher multiple going forward than it has in the past, because 10 years ago it was a hardware company, and it's becoming more of a service and software company. It's morphing that way. It's hasn't made the leap, but it's morphing that way. As the App Store gets a bigger share of revenues.
Which actually gets me back to Amazon. So I thought Amazon numbers were pretty good. I don't think any of the bad news that they discussed tariff related wasn't already incorporated into the stock's price. They do have a subscription model. They've got Prime, Prime Video, stuff like that. They have that as they have a service business, a very good one in cloud with AWS. And of course they have some exposure to retail, and they have some exposure to China. But at 25 times and generating free cash flow, it seems to me that it's hard for me to imagine that they do not continue to grab share from Walmart over time on the retailing side. It's hard for me to imagine that a virtual storefront doesn't have greater flexibility to deal with supply chain disruptions, especially when it's a virtual sales front, a payment processor effectively for a lot of other retailers that use their platform, than it is for a huge business that has actually built the bricks and mortar supply chain that actually has to contend with it, like a Walmart. So I don't understand for the life of me why Walmart should trade at a premium to Amazon.
Yeah, you're onto something there.
Um, Also, you mentioned airlines. Delta's basically back where it was, 4 or 5 years ago.
Yeah, I like the
And
airlines. People want to travel. No tariffs. Um,
yeah,
but so they don't have that. But people want to travel. They were locked up for a long time. They want to go back to normal. They are going back to normal. And so I think the airline stocks are very reasonably priced at where they're most of them now, around 10-ish times earnings.
yeah. I mean,
And they're
in Delta's
bringing
Delta's case is less than that, and I think
yeah, they're
it's in
bringing
the
their
single
debt down.
digits,
One of
maybe.
the things that kind of kept them down a little bit was their balance sheets were much better before the lockdown than they are now. And so they're doing a little bit of, some of that cash flow is being directed to reducing debt balances as opposed to being paid out to shareholders. I don't expect that to go on for a whole lot longer. That they're generating tons of cash now, and I think they can balance. They're in a position where they can balance both. Getting their capital structure where they want it, and paying out cash flows. I've also been
Yeah. So
very interested in as an ancillary to that, the hotels like Hilton. Hilton's been doing kind of better, and I think it's been trading at a fairly high multiple. Um,
we'll take a peek. I mean, it's right now it's trading 25-ish next full year 2026,
yep.
maybe a little more.
So that's come down a little bit since I looked at it, um, but I think those have are doing pretty well, and they've been showing some pricing power, better than I thought they would have. They've been able to raise their rates, their room rates, more than I thought they would be able to. So they're keeping up with inflation in that
Yeah,
regard.
I mean, on your airline front, I just want to bring something up. So Delta has a joint venture with KLM Air France,
Uh-huh.
and the CEO of KLM Air France is a guy named Benjamin Smith. People could probably go and find this video. It's an interesting one. He was on Squawk. That's Andrew Ross Sorkin, Joe Kernan, Becky Quick.
Uh-huh.
It's the first
Oh, in the
show on
morning, yeah.
CNBC. Yeah, yeah. And he was talking about what their business looks like. And he made a couple observations. So one of the things he said, our load factors have never been better in the company's history.
Yeah.
So that's second thing was, while he did see some signs of distress on the consumer side and that, they would see bookings drop, he said minor tweaks in price and they'd fill the seats.
Oh, okay.
So he's saying it's not like there's a complete demand drop off. There's a little bit of optimization work. Maybe the margins aren't quite as good, but they can put butts in seats if they need or
Yeah.
want to. Delta, for what it's worth, they do what do they call it? A code sharing, or they have a program where effectively, if you book KLM Air France and you're traveling in Europe, Europeans traveling here, they book with them.
Yeah.
Delta is what they fly domestically.
Uh-huh.
So, they're looking at 660 a share on 2.6-ish billion dollars worth of free cash flow, full year 2026. Let's call it $6
Mm-hmm.
for the next 12 months, right? So $5.50 probably full year. We'll call it $6 over the next 12 months. Let's just round it up and call it 40. So we're looking at about 7.5 times next 12 months earnings. Free cash flow yield in the neighborhood of, it looks like $2.8 billion of free cash on a $30 billion, I'm just using round numbers as I generally prefer to do, $30 billion market capitalization and a $47.5 billion enterprise value. It's pretty attractive free cash flow yield.
Mm-hmm. Yeah. And nothing wrong with that. So, but
Um,
nonetheless, that's also another capital intensive business, right?
Yes, and what you have here is you have elevated implied volatility. So I was kind of thinking that if we're looking for sort of trade-specific strategies, maybe a 50% allocation. If you put 5% of your allocations, let's say, into individual stock picks, right? So, $5,000 for every 100,000 you're investing. That would be a little over 100 shares in this case, which happens to work out conveniently for an options trade. Things you could consider would be like a cash-covered put sale, or getting a half allocation to this thing and then selling a strangle around it. So you're selling an upside call, selling a downside put. So if the stock rallies a little bit, you've collected some premium on both sides, you get called out, but then you can write puts to get your way back in. You know what? Why don't I just display this so that people know what I'm talking about?
Okay.
Because I do think that there's some attractive opportunities here to try to, look, implied volatilities come in a lot. But I think that on things that you could view as sort of a core holding but not a huge growth story, the airlines have never proven to be a good growth story, even when they've proven to be a good valuation.
They're not growth stories.
Yeah. So we'll just do this. I'm just going to pull this up on my screen. So things you could do a buy right. So buy the stock, sell an upside call. Oops. Oh, the Dallas News. Don't want that. There we are. Here we go. All right. So you could buy the stock and sell a covered call against it. Or something that I think is kind of interesting here is you can own the stock, sell a downside put, and sell an upside call. Oops. And we'll go out. This is 49 days June regs. Why not? So maybe you sell something like this, the 52.5s on the upside. And on the downside, we could look for something like an 18 delta should be fine. And you're going to get a structure that looks a little bit like this. So you got a standstill rate of return, potentially get called out. But if you do get called out, your upside break-even is going to be, upside break-even, where you're going to get called out of the stock is around $53, $53.50. That's actually over the course of 6-7 weeks. That's a pretty good premium to where the stock is now. So that you get called out, you're up 20%.
So you're selling a put so that you would essentially be doubling down in a.
Yeah, that's why I'm saying you do a half allocation. Because we just had a big rally, and I get it. Everybody who's ever bought or sold securities, you have a 10% rally in the S&P in 9 trading days or whatever it's been. Yeah. We've completely round trip Liberation Day declines from April 2nd, and you're saying, oh man, I could have bought the stock in the high 30s. Now it's trading $43. Do I really want to buy it here? $44. Well, then don't do that, but also don't bet. It never pays to be a pessimist forever.
Yeah.
So you gotta have something, and you gotta have some money at work. So do a half allocation. You were gonna buy a couple hundred shares, $9,000 worth of the stock. It's a little less. It's probably like 8,800. Buy 100. Yeah. Buy 100 shares. Spend $4,400. Sell an upside call. Sell a downside put.
Yeah.
Milk it for a little bit of premium, like that.
That makes a lot of sense. Because a lot of times people say, well, I want to put all my money in one shot.
Yeah.
And I often trade with the idea that, especially when I trade options and I'm writing cash covered puts, that I never buy my 100% of my allocation. It's always 20 to 50%. And then if things trade down, maybe I roll from one option and to go to two, and roll the strike down and lower my risk from a dollar standpoint. You got a little bigger exposure, but you can trade. But if you are stepping in, you're stepping at a much lower price.
Yeah, it's interesting. I don't think you were on for the video that I did this, but I did a video where we specifically talked about the fact that if you can get the thesis right, but if you wager too much on your bet size each time, you actually will reduce your long-term returns, even though your thesis was correct. Mm-hmm. And the reason is because the drawdowns have such a disastrous impact. And You've done some work
Yes.
on that. Your famous bullet curve, where you talk about the optimization of risk and return.
Yeah. Well, it's a matter of compound returns. So if you start with $100 and you lose $50, now you've lost 50%. But what does it take to break even? You need 100% return now to break even. And so trade sizing is really important that you don't let things on the downside get out of hand. It's easy to dig a ditch. And this is a big reason why Warren does what he does. It's like, yeah, if I could be, I'm sitting in cash and I'm making 4% in treasury bills with my money, but if I step in too early, I'm going to go do a Kraft Heinz and get clobbered, even though I think it looks like a bit of a value. And so instead, I'm going to sit back and wait till I'm sure. And that there are some free money sitting on the ground there that I could go grab. And because of that very thing, it goes back to his old saying. It's like, I got two rules of investing. As the first one is don't lose money. The second one is don't forget the first rule. I always found
Yeah,
that very snarky and annoying because I go like, okay, so how do I do that?
yeah.
For years, it's like, it's a nice conversation piece, but like, how do you really do that? And part of that is just you wait and you're patient and you wait for something that's worth $50 trading for 30. You get your margin of safety made famous by Seth Klarman. And
Have you read that book, by the way?
I pieces of it. I haven't read the whole thing. I really should read the whole thing.
It's yeah, for anybody who's interested, it's a pretty quick read. Klarman's book is. It's not in print, and you will find, I think, that to get a copy of it, there's some incredibly high prices. I maybe somebody could look it up. I go on Amazon and find out it's something ridiculous. But it's that it's big print. It's easy to read. People have actually accused us. They said the Options Edge. It was one of the reviews on Amazon. I saw that people complained about our book, The Options Edge. The font's too small.
Yeah.
I don't know how much we thought we gave to font size before that
Well,
book got published. I
the
don't know that there
publisher
was any.
the publisher picked that. So
That's Wiley's fault.
yeah, I'm gonna blame it on Wiley.
McGraw-Hill published your other book, though, right?
Yep. And it seems to me it's a different font but the same size, and so it appears to be a little bit bigger. Um, but hey, you live and learn. The next one, if we ever write another book.
Yeah, I think that one either deserves a prequel or a sequel. A prequel for people who thought it was too mathy, or a sequel where we update it for the current market regimes. That might be an interesting thing. FinWest says, "Hi, Mike and Mark. Good morning. Sorry for being late. We'll catch up on the replay. How did your earnings trades go this week?" I will say, so the earnings trade that I'm most focused on, and it didn't go the way I had hoped it would, was Amazon. It was basically a push. So I was short strangles, May 2nd strangles in Amazon. So I was short the 177 and do I still have the thing up? I closed that. I was going to say I actually take a look at so I was short the 177 and a half puts and I want to say the 215 calls that expired today, and I was long at the money May 16th 190s, 190 calls. And I actually was having a debate with somebody yesterday. Do we just do a straight calendar on the 190 line? Because the May 2nd, May 16th 190 call spread was $2 yesterday, which struck me as very cheap. Because, I figured that the value of that straddle was going to be an easy $9 coming out, the May 16th. So assuming that it was a complete push. But then I was like, but I'm bullish on Amazon, and I don't want to get into a situation where, things come out better than expected. The stock goes up, which is my thesis. It should. I like it. It's 25 times and growing at 15% and has a robust AWS business, so I like the stock. I said, I don't like to be right and wrong. And that's the worst thing that can happen as an investor. Your thesis is right, but the trade's wrong.
Yeah.
So I did the diagonal instead, and the stock went nowhere. And if I'd put the $2 into the calendar, I'd have doubled my money, because that's where the calendar opened this morning.
Wow.
Instead, it was just a flat push.
Okay.
But it would have been more. That was less painful. The thing is, let's go back to that just from a trading philosophy standpoint. I'm bullish the stock. So if the stock does nothing, which is what it did, and the trade's a push, I can't complain. You know, I hope to make money because I had options and because I had a calendar on. But the fact is, there is no trade that makes money in every scenario. I made the bet the stock was going up. It didn't.
Right. Yep. You've got to pick your structure, the one that gives you the percentage. You know, you're making this trade-off between the size of a move and the probability of a profit. You know, that's a hard thing to do, because you really want to be, well, I think about it as, let's say you just want to be straight up long calls if you're very convicted on the bull side. If you're not, then you think it's going to sit around. You want to think about calendars. You want to think about selling put spreads. You want to think about some other structures. So if the move is rather muted, you can still make enough money to make it worth your while.
Yeah, I mean, I will make one point, which is that, you know, I do not generally just buy calls or buy puts. I'm trying to remember the last time I ever did that in my personal account. When's the last time you did that? Just bought calls and something?
Maybe once or twice a year. Maybe once a year, twice a year. That's all I ever do when I write on the Options Edge, is play maybe once or twice. Sometimes what I do, since we want option strategies, if I really want to be bullish, I'll do a risk reversal. Buy the call, sell the put. So that I tend to do that more than just a straight up call, because it helps offset the time decay. So I'm very sensitive to time decay, and I think it's the biggest reason why the average person, maybe not the biggest, but is a big reason why the average person doesn't make money trading options, is, you know, you see something you can buy cheap at $2 or $3, and you hold it for 2 weeks. Now it's trading down at $1. And then you're trying to wonder what to do. Do I hold on and hope that I get a bigger move in the stock and I'm back in the black, or what? So managing time decay is, to my mind, a big deal. And so I'm with you. I'll do a risk reversal way more often than I'll just buy a straight up call.
Yeah, I mean, I generally will trade calendars going into earnings. You know, look, at the core of all of this, people who watch us probably know, you know, the foundation of our approach is that we're investors first.
Yeah.
And if you're an investor rather than a trader, what you're saying is, I have a sense of what I think this is worth, but I don't know when it's going to go to what I think it's worth, if ever, right? So because of that, it's very difficult for me to just take punts and just buy a call, buy a put, because it's not just decay. If there's an event, there's decay and vol crush.
Yeah.
You've got three things you have to think about. What's the stock going to do? And then I've got decay, and then I've got vol crush. Two of the things that are happening are working against me, which means I have to be really right.
That's right.
About the first part, the stock's direction and the timing of its move. Right. It's hard enough to get the direction right.
Yeah, that's right.
Let alone the timing. So, yeah. So Finwa says, I'm an overall seller, only buy options to keep my margin from getting out of hand. Yeah, I mean, look, this is a good example. I saw Tom Sosnoff. So I've noticed that I was very curious. I started to watch some of Tom Sosnoff stuff because they're big premium sellers.
Yeah.
And I thought, boy, it's been a tough environment for premium selling. And I think they like to sell a lot of stuff, you know, what we call naked, meaning you sell strangles. So you sell an upside call, you sell a downside put. Carter Worth does a lot of this as well. He has And actually, I've been evaluating some of his work. It's pretty good because he's very focused on the timing of when volatility might get compressed. And I noticed that they were using 16 deltas instead of 20, which I kind of remember they previously had done. And this isn't a higher vol environment. So think about this, folks. As implied volatility rises, the 20 delta option strikes are going to get further and further away from at the money, all else equal. And if you are both pushing it out and then also taking the delta up, I was wondering whether they have kind of a fixed premium target approach.
Yeah.
So in other words, in high volatility environments, you're still trying to yield about the same amount, so you push the strikes much farther away to accommodate the risk. Now, why do I mention this? Because let me show you two. I'm going to do this really quickly. I'm going to just, because I talk about it, and let's illustrate it. I thought this was kind of interesting, and I haven't spoken to them, so I don't know if this is true or not. But it occurred to me. So let's just say that you like to sell a 40. Here's a 42-day option. We'll sell we're going to sell a 20 delta put, and we'll sell a 20 delta call, and we're going to look at delta because we happen to be talking about exactly this kind of strategy in this stock. So just assemble that really quickly. This is a 22 delta option. Okay, and I'm going to sell both. So you end up with a structure that looks like this. Okay, so this structure is going to yield $1. If it expires worthless, you're going to get $1.76 over the course of 42 days. So it's 6 weeks on a $44 stock. Okay, so that's 4% on the number.
Yeah.
To the penny, as Carter likes to say.
Yeah.
You're getting 4% yield over 6 weeks. Not bad, right? But it is fair to say that volatility lives in regimes. In high volatility regimes, often the implied volatility doesn't go up high enough. And in low volatility regimes, implied volatility doesn't go down quite enough.
Yeah.
So if you said to yourself, well, I was only looking to collect 2%, that was kind of my target. In a high volatility environment, what you do to achieve that then is you push these strikes out, right?
Yeah.
So instead of, say, now I can move out to the 18 delta call, right? And I can push down to the next strike down, which is, this one doesn't seem like it's quite reasonably priced there. Now what are we getting? We're getting $1.06, right? So $1.06 is probably that's still 2.4. So but now I've pushed this out by another couple percent aside.
Yeah.
So there's an ETF that does this too, where they have a targeted premium approach. So they let the market tell them what strikes to select because they said, and as the volatility goes higher, you push your short strikes out. And to Finwest's point, which I think is a good point as well, people sell iron condors instead of selling strangles to cap their risk and to keep their margin requirements in line.
Really small.
Yeah. The only issue I have with this is that if you feel like you have a grasp of the underlying stock's value, and you would have bought the stock anyway, I feel more comfortable being short the put side, believe it or not. Because if you're ready to buy the stock here at 44, I think I'm ready to buy it at 37, which is the effective purchase price on the put side. The upside I get a little more worried about because those are the types of situations where you can have a corporate action, on the downside, you're bounded by valuation. On the upside, and that's, by the way, the lows. $37 was the lows, so in or around.
Yeah. So I like to think about this in a little bit, and this is actually would be an interesting quant study to do. Is if you were going to do that and target a yield, what happens is you're moving your strikes wider in the higher yield, right? A higher vol environment. And what can happen there? Well, if you're in the higher vol environment, you're probably going to revert back down. So you're going to come and probably stay within that. On the other hand, if your vol is super low, it's likely to jump and go the other way. So I'm wondering if that strategy is one in which you would be making a lot of small profits and every now and again just get your head ripped off.
Yeah. So what's interesting about this is that, so I noticed there's another, this has a really interesting impact. And let me illustrate this. Let's say that all you were doing was trading SPY. Okay. So you're just doing a market strategy and you're looking to collect some premium. And the way you do this is you sell cash covered puts.
Yep.
Okay. Well, if you were looking to sell cash, this might give you a sense of one way to think about this, or at least something that occurred to me. And I thought this was kind of an interesting approach that I saw in Exchange Traded Product Tech. Okay. So what we're going to do now is we are going to sell a cash covered put in SPY. We'll stick around that same tenor. Now, what else do we know about the S&P in general? What's a general characterization we can make about the S&P?
Well, it's the 500 best stocks in the country.
And they generally rise.
Yeah.
Yeah. The mean return for the S&P over a 1 month period is like 60 basis points, something like that, or maybe even a little bit more. I think in recent years it's closer to 75.
Yep.
Right. It's up more often than not, and on average it is up. So you're going to say to yourself, I want premium. What else do I want? I want delta. Well, how do you get delta if you're selling cash covered puts? You sell them slightly in the money, right? Right? Which is the same thing as doing a buy right. I bought stock and I sell an upside call.
Yeah.
So if I said to myself under normal circumstances, I want to sell a 2.5% out of the money 1 month call. But if you take a fixed premium approach, what would happen? That means that when volatility was high, you would sell a further out of the money call if you were long the stock, or you would sell a deeper in the money put. And when do we usually have higher implied volatility? When markets are depressed, when you want more delta. So I think, and that's the worst thing that can happen to premium sellers. You sell a put, market drops violently, and then you get put the stock, and then you sell a tight strike upside call to collect more premium, and it rips right back.
Yeah.
And you're a net loser.
Yeah.
So the advantage to this approach is that even if you did get beaten up a little bit on the way down, you give yourself more room to the upside to get back. So I would encourage people to think about that, because this goes to something else I've seen. I'm sure you've seen it too. People, they look for premium selling opportunities based on the premium itself. Like, oh, that's really juicy. Look at that. The implied volatility is 100. MicroStrategy, the implied volatility is off the charts. I'm just going to sell with impunity. Well, that can be good, but sometimes things are high for a reason.
Yeah.
Let's see what we have here. So Finwest says, to expand on my comment, the vast majority of my option selling are naked puts or bull put spreads. My only call selling are covered calls. Yeah, exactly. This is pretty much exactly what we're talking about, which is that I don't like being naked short upside. As a general rule, and this is because stocks rise in general.
Well, capital market theory tells us that stocks are priced. Any asset is priced to rise in value over time, rise in price over time. And the reason why is, why would you buy a stock at $10 if you think it's going to $9? Well, you wouldn't.
Yeah.
You would wait till it's $8.50, and you'd buy it at $8.50 with the expectation it's going to $9. And so that's a fundamental tenet of capital market theory. So it's why when we talked about in our book, our options fairly priced, we talked to a fair number of customers. Remember that they said, if I buy puts, I almost always lose money. And so we were asking the question, why is that? Well, if we go back to capital market theory, you should lose money. It's a negative beta asset. And negative beta assets have negative rates of return. Another way to think about that is buying puts is buying insurance on your stock. And you don't want your stock to crash, right? You buy insurance on your car and you're hoping the insurance expires worthless. Nobody wants to get in a wreck. Nobody wants to see their house burned down. The same thing is true. The same thing is true with put options, that they are a form of insurance, and so one should expect them to expire worthless most of the time, right?
Yeah, I think that's true. And you know, I will say that the worst thing, arguably one of the worst things for me as an investor, is that when I began my career as an options trader, we traded volatility.
Mm-hmm.
And as such, we were encouraged to remain what we call delta neutral. So that meant that we actually did not take a net long exposure in stocks. Now, there were isolated periods where we were glad that was true. We were glad that was true, I suppose, during the tech wreck, that we weren't net long deltas.
Yeah.
We were generally probably happy that that was true on the very unfortunate days following September 11th. We were impacted by that. Our business was impacted by that, and stock prices were impacted by that. But in the general case, you want to be long delta.
Yep.
You want to be long stocks.
Yep, that's true. That is true.
And I think that's probably as good a place as any to leave it, since we've chewed up about an hour and 15 minutes,
Yep.
and I know you have probably a long line of your best students eagerly awaiting your insights.
They're never here.
And
They're never here on campus. Somebody just knocked on my door. You know, what was it, a half an hour ago? I don't know if he was a student or not, but I'm gonna have to go into the lounge and go see if he's still there and see what he needs.
Yeah, maybe we'll feature some of them on one of these in the future and get them to ask a few questions. That could be kind of fun.
Yeah, we could bring some students in. We have some fun kids here. Yeah.
All right. Well, Mark, I hope you enjoy your weekend.
Okay.
Everybody who watched live, I hope you enjoy your weekend. And for those who are going to watch it over the weekend, I hope you're enjoying it. Thanks, as always, for watching, and we'll see you this time next week.
Okay. See you later.